My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I hope you, my friends, I'm just trying to make a little money. My job, not just to entertain, but to put this crazy market into context. So call me at 1-800-743-CBC or tweet me at Jim Cramer. When you get these kind of rallies, and you get them very rarely, it reminds you that you have to stay in this market to make big money. You can't flit in and flit out. When I say stay in, I mean that you have to be as invested as you possibly can be so you don't miss monster moves like the Russell 2000 up 3.5% today. Well, we always talk about the Dow, which had its own explosion, up 743 points to a new record, by the way. S&P 500 up 0.64, also new record. NASDAQ up just 0.2% thanks to being pulled down by the mega cap tax. But today's market is now being led by some real oddball stocks, specifically non-techs, a totally different kind of rally than what we're used to, when very few people even seem to know about the leaders. Hey, and don't I know it? The biggest winners in the Russell today, since this amazing rally began last week, are all companies I either don't know or that I've barely heard of. And you know, I know thousands of stocks. How's this all possible? What happened to the Magnificent Seven techs? Is it a breather or are they finished? Are we too overbought to get in now? Is it too late? These are important questions we must solve right now. Let's unpack this move and make some sense of it. First, this is an all-eccentric, amazing, really began to... When did this really start? It started when we got that cool consumer price index reading we got last Thursday. No inflation in the month of June. That's what triggered it. That's the first prop of the small cap rally. Most people are surprised to see that lowering of inflation could trigger a gigantic rally among so many small cap stocks. But when you take a look at the ones that are running, almost all are biotechs. And by the way, almost all are losing money. If you look at the top 35 performers, all of which are up more than 35% since in a week, less than a week, including 11 that are up more than 50%, you'll see that roughly half are biotechs and healthcare companies, almost all losing money. Conclusion, this is a market led by the most risky stocks, the Russell 2000 stocks, specifically money-losing companies that might be worth something years from now, but not at this moment. These are exactly the kind of stocks that only thrive when inflation is nil or we're facing deflation. After the CPI showed inflation on the ropes, it makes a ton of sense that these stocks would lead us higher. They're probably not done. Second, while the Russell 2000 may be leading us, there are a ton of stocks that represent what I call small and medium-sized businesses. Now, what do these smaller companies have in common? When I study them, I see many enterprises that benefit from lower interest rates, but I also spy a list of names that have been left behind by the big capitalization stocks. I want to generalize for a moment. I think these stocks are rallying because there's a sense that Trump's going to win the election, and then that will mean a rollback in regulations. The theory here is that the big cap outfits can easily negotiate the regulatory landscape, but the small, medium-sized businesses, they can't. They don't have the money or the connections to fight back. Would I want to embrace this thesis? Look, it requires a Trump win, which is not assured, followed by a successful rollback of federal rules. Again, not a given. But I do believe that these smaller companies have been hamstrung by regulation that actually benefits the big dogs because they can handle all the red tape. Small and medium-sized businesses do need to be unfettered for them to have a level playing field. You know what? This market's saying that will happen. Now, third, we know from the legendary Larry Fink, the CEO of BlackRock, that investors increasingly want to take more risk because they're more optimistic about stocks, not about the country, about stocks. This view surprised me given the palpable sense of gloom in America. But the investor base sure isn't gloomy, or they wouldn't be buying so many risky stocks or risky ETFs. The money is coming in from the sidelines, where it had been collecting very high interest, at least relative to the last couple of decades. But now the return you can get from cash isn't as attractive as what you can get from stocks, or it certainly won't be. Considering the huge number of stocks that have rallied, 348 Russell 2000, up 20% in the last 5 days. A staggering 1,262 stocks, up 10% in that same period. Who can blame people seeking a better return than they can for a 5% annual payout that you can get from a certificate of deposit? Fourth, many of the stocks that are flying below the recently down and out home builders, for instance, the retail sectors, they're starting to rally because mortgage rates are coming down, or perhaps maybe because of the retail sales report that we got this morning that was pretty darn good. Even the home-related and healthcare stocks in the Dow Jones Industrial Average roared today. It's as if when we get the CPI reading, the Fed now has a green light to cut rates, maybe again and again, which means you have no choice but to own that kind of stock. Smaller home-related stocks did even better, which makes sense because they're all playing catch-up. Fifth, many of the biggest winners are companies that you might have expected to receive takeover bids under a different regulatory regime, one less hostile to mergers. But the Biden administration is the most anti-takeover presidency in modern history, and possibly all of history. Having studied antitrust closely since law school, that's actually a fairly easy statement for me to make. The smaller these companies are, the easier they are to buy. And you will absolutely get more deals if Trump wins the election. The big banks have hinted at the upcoming deal making on their earnings calls with their rhetoric about how M&A is heating up on their very positive conference calls, and that can drive a stock market higher. Six, there's a recognition that if Trump wins, again, taxes, especially taxes for the wealthy, the people who mainly buy stocks, are going to come down. People want to get in ahead of that. Finally, seventh is about magnificence, or more accurately, less than magnificent. We're seeing a wholesale rout in big tech. These moments tend to be very self-fulfilling. People see a small cap rally. They know big money can be made potentially overnight. Some of that money, as I indicated, can come from the sidelines, but some of it's coming out of these big tech winners. I don't know if you could have this Russell 2000 rally without the ammunition provided by investors selling the big cap techs. Don't worry, the big cap techs aren't finished, but they might be paused until the small caps finish playing catch-up, which could take some time. The biggest takeaway from this incredible rally, there were so many charlatans who said that you have to wait for a broadening out before you can buy stocks. I said over and over again that the market doesn't give you that kind of chance. It just happens too quickly. The window for eclectic gains like this one, we've had it since last Thursday, is incredibly small. It doesn't stay open for long. And now the stock market is extremely overbought, much more than I like. And it's a dicier time to get in, much dicier than a week ago. I'm going to make that point tomorrow at our Investor Club meeting. If you've been waiting for the market to broaden out, you most likely missed this mid-summer bounty. In the end, it doesn't matter if you think the rally is being caused by the possibility of a Trump presidency or the decline in inflation or the likelihood that the Fed will start cutting rates. What matters most is that unless you're invested all the time, instead of trading in and out and in and out, you'll miss these enormous moves. Bottom line, this shocking rally is why I abhor the relentless emphasis on trading. Believe me, those traders who left the market waiting for it to broaden out more, they are licking their wounds right now because they know they missed what could be the easiest money that has been made in years. The only way to profit from rallies like this one is to own the darn stocks ahead of time, if they spend so long out of favor. You can't just get in and get out back on a dime. Only true geniuses and liars can lay claim to staying out of small, medium-sized cap stocks for years and then jumping back in 4 business days ago. William in Michigan. William.
Hi, Jim. Thank you for taking my call.
Thank you for calling, William. What's taken?
With the recent pressure on enterprise software stocks, as well as the recent security breaches for Snowflake, I would like your thoughts if you think the negativity is already priced in and if it's a good time to buy the stock.
You know, I thought, until I read more about the hack, I thought that maybe the negativity was priced in. But I have to tell you, the hack was a really bad one. And I say maybe you got to stay clear of Snowflake for a bit. I found it very curious, frankly. Let's go to Bo in Florida. Bo!
Madman, what's going on?
Not much. What's shaking with you?
I am curious. Retail sales look pretty good today, and I'm curious if you think it's time to start buying into Lululemon.
Oh, wow. Okay, Lululemon. Wow, this thing is so down. Now, we are so overbought. We are +8 on the S&P oscillator that I follow. I cannot countenance buying Lulu on that. But I will tell you, it seems like it has found finally a base at 282. By the way, I'll give you a 2 for RH, seemed to bottom today, too. But I don't want to plow in because of how overbought and too excited this market is. Let's go to Tommy, my home state, New Jersey. Tommy.
Hi, Jimmy. Is that Tommy from Lafayette, New Jersey?
Lafayette. Love it. Love it.
Thank you for all you do for us.
Oh, you're quite welcome. What's going on?
My mentor. Listen, Meta has been having some crazy times. They're getting The analysts are screaming 600, 620, and the stock is dropping.
Well, look, it's had such a run. Okay, so listen, Tommy, here's my thinking. Meta's going to have to just mark some time. There's a July 29th meeting where Mark Zuckerberg is going to sit down with Jensen Huang, amazingly, in the same room. Can you believe it? But I think the stock marks time. It's had such a big run. It's up 38% for the year. Let's give it a little rest, okay? A little R&R on Meta. That's what's needed. The biggest takeaway I can give you from this rally is that you have to stay invested all the time. If you try and trade in and out all the time, you probably miss most of what is one of the most amazing moves of my lifetime. On Mad Money tonight, with earnings in full swing, I'm testing my thesis on the two big banks that I think could keep running higher. Don't miss my deep dive on these firms. Then, diversification is a staple of Cramerica, so I'm going off the chart to see if a well-rounded portfolio is still the secret to success in the long term. And later, is Celsius losing its energy with consumers? I don't know. I had 6 of them this morning. I didn't mind at all. I'm talking to the data company 100X on some new research the company just published. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All year I've been telling you that the sweet spot in banking is now investment banking. And of the major banks, the two with the most exposure are Goldman Sachs and to a lesser extent Morgan Stanley. Without major consumer banking operations, these two companies are less hostage to the shifting winds of interest rates and more dependent on the gradual ramp of the capital markets, which is exactly what we've been seeing. So after Goldman Sachs reported yesterday morning and Morgan Stanley reported today before the open, how's the thesis holding up? What have we learned from the investment banks? All right, let's go chronologically, starting with Goldman. They turned in what I describe as a good, solid report, a top and bottom line beat that was strong enough to send the stock up over $12 or nearly 2.6% on Monday, before tacking another 2.19% today, hitting new all-time highs in the process. Wow. Although some of that likely comes from the new consensus that we're headed for a second Trump presidency with a lot less onerous regulation expected for all the banks, including investment banks. So Goldman's numbers, they were excellent. 14% revenue growth. Two major segments beat expectations. Global banking and markets up 14%. Asset wealth management up 27%. That really shocked me. It was so good. Within global, remember, I did work there, and that's just spectacular numbers. Within global banking and markets, which is the core business, Goldman's fixed income, currency, and commodities trading division, that's called FIC, was up 17%. Equity trading up 7%. The only miss within global banking and markets was the investment banking business, which actually put up 21% revenue growth, but still came in shy of expectations. Within investment banking, debt underwriting was up astonishing 39%, equity underwriting up 25%. They were both above expectations, but the financial advisory business came in weaker, only up 7%. That I didn't understand. So this was a good quarter, but I know it could have been even better. Now, I've learned through my reporting that Goldman was involved in two major M&A deals that got a little delayed, moving from the second quarter to the third quarter. They were advising Six Flags in the Six Flags Cedar Fair merger, and they were advising WestRock in its sale to Smurfit Kappa. Both these deals closed earlier this month, just after the quarter was over. So even the one small issue with the quarter, the financial advisory business miss, was only a problem because their M&A division saw a couple of major deals slip into the next quarter. Hey, in other words, they're going to make it up next earnings season. How about expense control? Not perfect, pretty good. They've made still some strides here versus last year. And with such a large revenue beat, Goldman was able to deliver a 31-cent earnings beat off of 8,031-cent basis. That's 180% earnings growth year over year. So great overall numbers for Goldman, but even better, the forward-looking metrics and comments from management inspired a lot of confidence, especially for the company's bread and butter investment banking and sales and trading businesses. On the conference call yesterday morning, CEO David Solomon, who's rapidly turning into a hero for this franchise, said that Goldman investment banking backlog had increased significantly, his word, not mine, in the quarter, and described the capital markets and M&A recovery as in the early innings. I used to call this company Golden Slacks, and sure does feel like it deserves that nickname again. Plus, even with the stock hitting new highs right now, it sells for less than 14 times earnings, this year's earnings estimates, roughly 12 times next year's numbers. That is not expensive by any stretch of the imagination.
House of pleasure.
It's a buy. So what about charitable trust holding Morgan Stanley? They reported this morning and also turned in a clean top and bottom line beat with 12% revenue growth. Not bad. Their two asset management businesses, investment management for institutional clients and wealth management for individual clients, grew by 8% and 2% respectively. That wealth management falling a little short of expectations thanks to lower than expected net interest income, but it wasn't good enough. In plain English, Morgan Stanley's wealth management clients kept less cash at the bank because they could get higher rates elsewhere. That's one reason these guys could benefit from a September rate cut. They've become, in my mind, like Wells Fargo, the two big beneficiaries if we start seeing Fed rate cuts. Other than that mild wealth management shortfall, Morgan Stanley had $7.2 trillion in total client assets, puts them well on their way to their goal of $10 trillion. By the way, BlackRock has $10 trillion. I mean, they're unassailable. But no one's worried about the light wealth management number today because Morgan Stanley's other division, Institutional Securities, which houses their investment banking and sales and trading businesses, that performed much better than expected. Institutional Securities segment had 23% revenue growth. Its three divisions coming up ahead of expectations, too. Investment banking up a staggering 51%. I have no idea how they got that number. Equity trading up 18%. Fixed income trading up 16%. Really terrific. Now, Morgan Stanley also did a phenomenal job of controlling costs, which let them translate their better than expected revenues into an impressive 17-cent earnings beat off $1.65 basis. The return on tangible common equity, really boring, but does matter. Key profitability metric came in at 17.5%. Wall Street was only looking for 15.8%. Bye. As Investing Club members know, and remember, we do have a meeting tomorrow at noon, I've been a bit frustrated by Morgan Stanley's slow start to the year. As new CEO Ted Pick found his sea legs and investors figured out what to do with the stock amid a shifting interest rate environment. While Morgan Stanley is less dependent on the direction of interest rates than the big money center banks, it still has some exposure because of this sprawling wealth management business. But the stock's been coming along nicely these past few months. It's climbed from mid-80s in mid-April to more than a two-year high of 109 earlier today, though the stock pulled back from those levels to close at $106.22. That's up 0.91% for the day. Remember, it made the pit stop at 109, but it also traded as low as 102 before the conference call got pretty darn bullish about equities, M&A, and the future. Basically, after some of the noise and choppy trading earlier this year, Morgan Stanley's finally trading like I thought it would when we bought it for the trust. The bull thesis is at last working. I'm not too concerned about the miss from wealth management because it was interest rate related. I believe rates are headed lower. Now, that was really the only hair on this one. I still think it's early days for Morgan Stanley's institutional securities business, with the firm's CFO, Sharon Yeshaya, saying that, and I'm going to quote here, investment banking pipelines are healthy and diverse, dialogues are active, and markets are open. Sounds good to me. Despite the stock's run from mid-80s to the triple digits over the past 3 months, Morgan Stanley still trades at around 15.5 times this year's earnings estimates, 14 times next year's numbers, and it's got a 3.4% yield. That yield, of course, will only look more attractive as rates come down. So we don't see any reason to back away from our bullish stance on Morgan Stanley, the Travel Trust, and I'll reiterate that at tomorrow's meeting. Here's the bottom line. The investment banking business, it looks good. The banks, Goldman Sachs and Morgan Stanley, have been a great place for investors to be in 2024. As capital markets activity gradually comes back, although now it's feeling a lot less gradual, isn't it? And based on what we've seen over the past 2 days, I bet both stocks have maybe a lot more room to run. All aboard! Mad Money's back in for the break.
Coming up, are the big funds in big trouble? Cramer goes off the charts for a read of the averages next.
The most difficult thing about this market is that until the last few days, investors keep getting punished for being diversified, even though we know that's the safest strategy long term. We saw that today as the lagging Dow Jones Industrial Average came roaring back. Right now, the S&P 500 and the NASDAQ 100 are both at all-time highs, but many diversified portfolios are doing far worse. Take the Vanguard Target Dated 2030 fund, which is designed for those looking to retire around 2030. Automated portfolio, classically diversified. Yet its net asset value per share is still down roughly 15% from the peak in 2021. Some of that's because there's nearly 40% bonds. And if you own bonds when the Fed started tightening in 2022, you got obliterated. So much because this has been a narrow bull market with strength concentrated in the Magnificent Seven, not the broader market, at least until the last few days. So what happens when tried and true diversification causes so many people to get left behind year after year, while those who chase outside risk are rewarded handsomely? Well, frankly, nothing good. That's why we're going off the charts with the help of a dispassionate person, Carly Garner. She's a terrific technician who's the co-founder of DeCarly Trading, the author of Higher Probability Commodity Trading, and someone with an excellent track record, including calls she's made on the show. Garner says we're playing a dangerous game of musical chairs in this market. Nobody knows when or where the music will stop, but it'll stop abruptly, and not everyone gets a chair. Now, I need to make clear, very clear, okay, especially to those who blog or tweet about the show, I am not in agreement with Garner. I feel more constructive about this market. But on Mad Money, I like to present alternative views to show you the other side of the trade, especially when they come from people I respect. It can be very eye-opening. Garner thinks history is repeating itself here. I don't think we're going through another dot-com bubble. There are real differences. But the concentration of winners in one area does feel very similar. Back then, you could clean up by just going all in on a handful of risky tech stocks and just sticking with them. The best performing mutual funds abandoned the very idea of diversification. Then the dot-com bubble collapsed, and anyone who tried to ride it out got obliterated. They pretty much never came back. As Garner puts it, you can absolutely get rich by taking excessive risk, but going all in on a single sector, staying rich with that approach, a different story. Now, I agree with her on diversification, but I think she's wrong about the state of the market. Still, with that in mind, what does she see in the E-mini S&P 500 futures? Take a look at the monthly chart here. For those of you keeping score, while so many commentators were pounding the table calling for recession and lower stock prices last year, Garner told us that the S&P 500 could break out above 5150, including right here on Mad Money. At that time, that seemed like an extremely bullish call. I remember it, but in retrospect, Garner thinks she was way too conservative. Not only have we blown through that level, she thinks the chart has opened up to the possibility of the S&P reaching 6150, okay? That's up nearly 500 points from the record, which we created today. But, and this is a very big but, if you want to chase after these 500 points right here, Garner believes you'll be taking on double, maybe triple the risk versus what we experienced from the last 500 points. Yep, even though we've had an epic run here, she's now picking up some warning signs that make her feel substantially less bullish. Most alarming, Garner points out that there's been a persistent divergence between the S&P 500, and the relative strength index, the RSI. That's an important momentum indicator. When the S&P peaked in early 2018, so you can go back to where we were, right here, when it peaked, the RSI stood at nearly 88, perhaps the highest overbought reading ever produced for the S&P futures. Back then, the S&P 500 topped out at near 2880, and if we ever see that level again, oh boy, I'm sure you need to take away the ties and the shoelaces because half of Wall Street will be on suicide watch. That was only 6.5 years ago, though. We've almost doubled from the 2018 high until today. Here's what Garner finds worrisome. Since 2018, the S&P's made a series of significantly higher highs, but the relative strength index, the RSI, has never gotten as overbought as it was in 2018. It keeps making lower highs. The RSI made a lower high at the peak in 2021, and it's making another lower high right now. The problem with that is that these RSI divergences are often a sign of imminent reversals, especially when you're in a rally that's already overextended. In Garner's view, heavy government stimulus has enabled the stock market to trade well beyond its customary and reasonable trajectory. Look at the blue lines in the chart. See these? They represent what she thinks would have been the historically average trading range for the market in a world where the Fed hadn't massively increased the money supply. Without that stimulus, Garner thinks the S&P would be bouncing somewhere around, say, 4,750 and 3,500. So she thinks it would be all the way down here. When you see we're all the way up here, she thinks we'll be all the way down there. She recognizes that nobody wants to hear this, but the only way to normalize the market is either through the passage of time, something that she says will take years, not weeks or months, or through a nasty sell-off. Hey, maybe a little bit of both. If history's any guide, Garner thinks the market either needs to trade sideways for several years or the S&P needs to lose about 1,000 points before we get back to normal. My view. Look, Garner could be right, but I'm much more inclined to believe that there is no normal to go back to. Both presidential candidates have embraced a more active role for the government in managing or protecting the economy, even if they come at very different angles. Biden's Mr. Stimulus to begin with. And as for Trump, I mean, do you really think he'd do nothing if he saw the averages swooning? All right, next up, let's check out the monthly chart of the E-mini NASDAQ 100 futures. From NASDAQ 100, we know tech heavy, right? Once again, Garner believes the NASDAQ 100 is coming in too hot. It's spent a decade gaining 7,000 points. Okay, so took a decade getting to here, all right? And then, whoosh, managed to put on together a 10,000-point rally in just 20 months on the heels, again, of massive COVID stimulus this time. And yes, the Fed's still easing money policies. Then after tech pulled back hard in 2022 and 2023, as the Fed raised interest rates, what happened? We got another parabolic-style rally, this time fueled by tales of artificial intelligence. That's the last bit. So this is the COVID stimulus, and then this is the AI trade. This time, the NASDAQ 100 gained 10,500 points in just 21 months. Wow. Whether we're talking scale or duration, Garner notes that this is almost exactly the same as the rally that ended when the Fed declared war on inflation in 2021. And we remember how bad that was. Can the NASDAQ 100 keep running? Sure, but Garner thinks it's unlikely to be sustainable. Like the S&P 500 chart, she sees an RSI divergence in the NASDAQ 100. Here we go again. This red flag can be waved for months before consequences arrive, but they always come. In her view, the tech-heavy index is overbought and likely due for a beatdown. Now, it is hard to describe this as not being overbought, isn't it? I mean, look at that. That is pretty much parabolic, and I'm nervous about that. I'm concerned about it, not nervous. As Garner sees it, volatility is historically low, and the indices are at all-time highs, so there's never been a better time to hedge your bets, take a little off. In the end, it's not that she thinks a sell-off is imminent, but that this is a market with much worse risk-reward than it even had a few months ago before it went on this tremendous tear. Here's the bottom line. The charts as interpreted by Carly Garner suggest this might be the moment to pull in your horns in the S&P 500 and the NASDAQ 100. Now, we've had huge gains, concentrated in a pretty small number of stocks until the last few days. And Garner doesn't like what the charts are saying about the sustainability of these moves. Doesn't mean the whole edifice will collapse, but it's certainly a good reason to stick with diversification rather than piling all your money into the Magnificent Seven as they come down. I think they're worth owning, some, not all. Absolutely not with your entire portfolio. Let's take some calls. Let's start with John in Indiana. John.
Thank you for taking my call, Jim. Can you hear me?
John? John in Indiana.
Yes.
John.
Yes, Jim. Can you hear me?
Yes. Is John?
Yes, this is. Thank you for taking my call.
Of course. How can I help you?
So I have a question. In 2021, I bought some PayPal when it was climbing and near 200, and then shortly thereafter there was that, what they called, I believe, a correction where it dropped a large amount, and I've been holding on to it since then, and hoping that it would come back up, but it hasn't. So my question for you is, would you just sell it, and should I cut my losses, or hold on to it, or would this be a time to...
Look, this is a great question, John. I would tell you that if you're listening to Bank of America's Brian Moynihan today, I found myself thinking, why do I need PayPal? Because Bank of America does the same thing with its different methods of artificial intelligence and certainly with its systems to move money around. So I am going to say I would sell PayPal because even though I like this fellow, Alex Chris, the CEO, I would sell PayPal, and I would even buy Bank of America if you were similarly inclined to buy another stock. The charts of the S&P 500 and NASDAQ, as interpreted by Carly Garner, suggest it's time to take some chips off the table. We've had a huge run here up to this point, and Garner isn't too optimistic about this rally's sustainability. We got a lot more money, including my exclusive with 100X, where I'm catching up with some of the company's latest consumer data, including some important intel on Domino's. Plus, we're getting some mixed signals on the macro, aren't we? So what am I looking at for a proper read of the situation? I'll give you my take. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Right now, virtually every consumer-oriented business is trying to retain customers by offering them better value. Because if you keep your prices high in this environment, you're being punished. But who's actually pulling it off? Find out. We're checking in again with 100X, the alternative data firm that recently came under our radar. I like them. They've got the latest customer insights, including fresh data from last month. Of course, these guys aren't stock pickers, but they are very good listers. And their focus on purchase intent can show us what people actually plan to buy in the near future. Oh, and by the way, they provide funding for nonprofits when their supporters provide the data. Maybe that's why I like them so much, too. So let's welcome Rob Pace, who's the founder and CEO of 100X, to get his company's latest insights from the consumer source data. Mr. Pace, welcome back to Mad Money.
Yeah, thank you.
Once again, you have tremendous insights, and you're involved with saying some intent purchasing for pizza. which is a category that we have loved. So tell us what you come up with, Bob.
Yeah, so if you step back, your central thesis of consumers being very focused on value is what we're seeing in our data. And our future purchase intent for pizza is at two-year highs. And that's led by Domino's right now.
Now, Domino's is the cheapest, and it's also the one that brings it to you. But what are your people saying about the taste?
Well, that's always been their Achilles heel in our data, but they've closed the gap. You know, they introduced a number of new products, and we're seeing that in our data. And so from a value standpoint, consumers are saying the rest of quick, fast, casual has seen their pricing sentiment decline 10 points. Pizza has stayed flat, and Domino's has addressed the taste issue. So that's why it's one of our top companies in terms of future purchase intent.
Okay, let's stick with that theme, because you've done work on wireless. Now, I can tell you that anecdotally, I like Verizon Wireless. It's terrific, but it's expensive. But empirically, we're getting different data from you.
Yeah, if you think about the three big carriers, right? We see T-Mobile actually breaking to the upside versus AT&T and Verizon. And you're exactly right. Verizon scores better in terms of network quality and coverage, but T-Mobile is good enough, and on plan options, on value, on pricing, they're 20 points higher. So the consumer's saying it's good enough for the product, and I can save money.
Yep. I like to look at your stuff. Your stuff is just so good for me. I get very excited about it. And I've been trying to figure out, hey, listen, Verizon Wireless is really terrific, but this T-Mobile stock, now that's not your job, that's my job, has been on fire. And now I realize that a frugal consumer might just say, you know what, I don't need perfect wireless. I need wireless that works, and I want to save some money. That's why I think the stock's going up. Now, let's go to something that I think was pretty shocking. I go on Amazon, I see Celsius. We're big drinkers, Celsius. Suddenly I see these cheaper prices. Costco, I see these cheaper prices. Then I read that, maybe the sales, I read this data which indicates sales may not be good. But I was blown away when I saw your purchase intent.
Yeah, unfortunately, our purchase intent for Celsius has declined 15%, which is a very large move in our data over the last year, and just in the last 3 months, 10%. And what's going on, and that is indexed versus, say, other sodas and the energy drinks, et cetera, is historically they had a huge perceived advantage around healthiness, around ingredients, like 50, 60 points higher. And we're seeing that come down another 20, 30 points.
Hold on, let me understand this. The rap on Celsius was, listen, it's good and good for you. Right. Are people starting to believe that maybe the good for you rap may not be any better than some of these other drinks?
Yeah, that's what we're seeing in our data. And we're seeing it, the comments are about caffeine and the ingredients, et cetera. So historically, that was their edge, is it gave you energy and was healthy. And we're seeing a pretty significant erosion of that's playing through into future purchase intent.
Wow, that explains why the stock may not be done going down. I was hoping that PepsiCo might want to buy the rest. They have a stake, but they see the data like you do. Okay, so they're not actually. You see the data, but probably before they do, because you're doing right at the purchase intent moment. One of my absolute favorite stocks has been Pinterest, because I think that that's a place that you can reach a lot of people in a non-combative setting, where advertisers can say, you know what, I want hobbyists, I want people who are just kind of making their decisions about certain products early on and going right through. It sounds like that you're seeing similar, maybe even better work on Pinterest.
Yeah, Pinterest, again, is one of those names that's breaking to the upside. And you're exactly right. People go to Pinterest to discover things, but they also have a very good navigation and very good app.
Better and better.
Yes. And, Reddit might be the exact opposite of that, where they get good content, but it's hard to find. But what's fascinating to me on Pinterest is it's the first example that we can really focus on where they're AI-related products, collage, where they allow you to kind of take pins and put it together, where we're actually seeing that have an impact. And ultimately for AI, in our opinion, to be hugely successful, you're going to have to see the applications. And this is one of the early winners of the applications that we see.
Okay, so Rob, just because I am so enthralled with your model, which is not just the model, I'm going to make a lot of money and maybe one day give it away. You're making money for charities right now. How would you have gotten that Pinterest data, and then how would you make the donation?
Yeah, so right now we're running 100 programs around the country, and it's very diverse. And what the nonprofits do is they say, hey, there's this crazy company, 100X. It's raised a lot of money, and they're going to give us money to fund our new medical researcher or our kids' band room or whatever it is. If you all sign up and just tell the truth about the brands you use, who matters to you, and importantly, are you going to use them in the future? So every hour we're giving away thousands of dollars to charity, and we feel like the product's better because of it.
How can you beat data where people know that they're giving away money to their causes? That is a terrific model. You are very smart, my friend. That is Rob Page, the founder and CEO of 100X. I hope you're as turned on by this data as I am. It's how you and I, can make some money by listening to the purchase intent. Mad Money's back into the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Chris, that's for Rob Carl. Companies say the name is stock. I tell you about bites. Also, just go to the core stock question at the time. My stand first, the graphic, you play this out. And then the lightning round is over. Are you ready? Ski dag. Time for the lightning round. Let's start with Kimberlyn in New Jersey. Kimberlyn.
Hey, Jim. Booyah. First time caller. And I'm actually calling in regarding my daughter's portfolio. So we opted to not do a 529 plan, and we have a portfolio for her, and she's going into ninth grade, and we want to maximize our investment. So we're looking to add a cybersecurity stock. And I've been researching all of the above, like Palo Alto, CrowdStrike, and then Fortinet. So I want to get your take on Fortinet.
Well, I think Fortinet is not my favorite. Palo Alto is. We own it for the Travel Trust. We'll be going over tomorrow. And I think it is at the club meeting, and I really like its prospects. Let's go to Mary in New York. Mary.
Hi, Jim. I'm in a women's investment club called Stocks and Bonding. And one of our investments is air products and chemicals. We chose this because it provides crucial gases and chemicals for industrial use. But even with these very important products, the stock is not appreciated as hoped for. Should we hold or sell? And could you comment on the sale of their liquefied natural gas division to Honeywell as to the
Well, I got to tell you right now, the Honeywell got the better end of that deal. Honeywell did terrific on that. And you really don't want to be in Air Products. You want to be in Linde. Linde's a much better run company, and that's why Air Products isn't doing as well, and Linde's doing spectacularly. Let's go to Ian in California. Ian.
Hey, Jim. Ian here from California.
Excellent.
Long-time watcher, first-time caller.
Perfect.
Sarepta. Got to do something for the boys.
Now, look, I think Sarepta is a speculative situation where they have great science. I am never going to bet against a biotech company with great science. Therefore, I bless owning the stock. It's too risky for me, but it's okay if you want to be there. How about Jeff in Massachusetts? Jeff.
Jimmy Q, what's up, brother? Match
I don't know.
Terrible. Been stuck in a hole for a while with it. Should I sell it? What do you think?
No, don't sell Match. You just got a very, very smart investor in there. You got Starboard. There's been other activists there, too. And I think the Starboard letter, which I read this morning, is superb. And Match has to make the changes that Starboard recommends. Let's go to Marty in Connecticut. Marty.
Booyah, Big Jim, and greetings from New Haven, Connecticut, the pizza capital of the world.
I didn't know that. I learn something every night here. What's going on?
We want to know about BJ's Wholesale, Jim. Multiple positions.
BJ's Wholesale is very good. My problem is why would I want the very good when I can get the best, which, of course, is Costco. I was listening to the late Charlie Munger being interviewed by Becky Quick about Costco. It made me feel so good about the situation. The stock is running a great deal. Let's go to Rob in Ohio. Rob.
Booyah, Cramer from the heart of it all in Bell Fountain, Ohio.
I knew that was the heart of it. I just had that feeling. Yeah.
Jimmy, I bought my first stake at $27 a share in 2022 after their IPO bomb. I then doubled down with your boy, Josh Brown, in July of 2023 at $26 a share, thinking the Brown boost was the saving grace I had been holding out for. Help me, man. You're my only hope. Ticker, TOST. I
remember when Downtown made that call and then the stock went down and he just stuck with it, which was very, very right. Now, the problem with that is that you are investing in retail by doing that. And I do not want to be as exposed to retail right now And so that's the only reason why I do not want to own the stock of Toast. Now we're going to Rick in Pennsylvania, please. Rick.
Yeah, I was wondering what you think about a pharmaceutical stock called Teva.
Well, look, Teva's okay. I like there's a very low multiple, which is exciting, but what I really like is the best. I like best of best. I like best of breed. That means I like Eli Lilly. I need to go to Paul in Virginia. Paul.
Hey, Jim. How you doing?
Good. How about you?
I'm good. So I'm originally a New Yorker, so how you doing?
Well, yeah, that's how we talk. We talk like that in Philadelphia, too, but we can't pronounce the word talk.
Good. Okay. So listen, my wife and I just got back from a cruise, and I was so impressed with the ship and the crew and the experience that I opened a small position in this company. You know, they don't compete with the monster mega ships. They're smaller ships. They target 55 and older clients, kind of affluent, that aren't looking for floating game shows and casinos. They do river, ocean, and expeditions. And it seems to me they're killing it. You know, their ships are going out full, their fleet is expanding, and I'm talking about Viking, V-I-K.
I agree with you. I think Viking's terrific. I would put Royal Caribbean and Viking at the top of the heap. They are both excellent. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Something's very out of whack here. We've just gone through the most difficult, strenuous rate cycle in the history of the Federal Reserve. And what do we have? How about incredibly low unemployment? How about bank after bank today noting that credit defaults are either low or totally under control? How about commercial real estate actually being attractive as an investment in some cities? How about the stock market hitting record high after record high after record high? So then what's with the incredible sense of gloom that seems to surround everyone I meet? How can the negativity, the pessimism be so thick that you can cut it with a knife? What explains this extraordinary disparity, the collision of two worlds, one lacking in hope and the other so hopeful that it truly feels like we're in the good old days? When I survey this situation, I come back with two very different theories. The first is that inflation, very specifically the supermarket inflation, has really put people in a very bad way. Wages may be solid and jobs may be plentiful, but when you go grocery shopping, you're stunned by the prices. You simply can't believe that they haven't come back down one bit since COVID. Grocery prices are the reality of the moment, not the default rates or the problems of commercial real estate or the stock market hitting new highs, which feel totally divorced from the day-to-day lives of Americans. It's true. The grocery store aisles are so out of whack that you have to ask yourself, is there a law which says that packaged goods companies aren't allowed to cut prices? It sure feels that way. If it weren't for Costco's Kirkland Signature brand premium private label or Walmart's Great Value brand and this new Better Goods brand, which I really like, you'd think that we're still in the midst of the pandemic where raw costs soared and supply chains were completely crushed. We're beginning to see some revolt by the consumer, but nothing like what you'd expect. Instead, people just seem to be resigned to price gouging. We feel like we're back at that Jimmy Carter era, where the president infamously talked about how the country was filled with discouraged people, in part because of the inflation at that point at the gas pump. That talk, dubbed the Moyles speech, even though he never used that term, resonates more now than it did back when Carter spoke about it in July of '79. Never mind that inflation's cooled down to the point where the Fed can probably start cutting rates in September. We're in much better shape back then, but it somehow feels worse. The second theory, how about politics? Soon after Carter gave that speech, his Republican opponent offered a different message, one of hope and unity. Reagan beat the incumbent president in a landslide. After an initially very rocky period as the Fed ruthlessly raised rates to beat inflation, we had a sustained advance in hiring and the start of the greatest bull market in history. Now, we have an election filled with hatred and rancor, devoid of the genial positives that made Reagan so popular. When you have this kind of anger and ugliness in Washington, it pervades every aspect of our lives. Everything positive seems like nothing more than abstraction. I know that Trump said he will allow Jerome Powell to serve out his term at the Fed, which runs through 2028, said that in an interview this evening. He's considering J.P. Morgan's CEO, Jamie Dimon, as Treasury Secretary. Jamie's a centrist. Could matter. Could cool things. But the hatred, the fighting, the craziness, it sure has to die down, or we will all be pessimists eventually. You know where there's sustained optimism, though? Right here in this room, Wall Street, where profits are leading to ever higher prices for so many stocks, of which you can own. The market, which reflects the reality of the economy, is benefiting plenty of people, but not nearly enough to change the mood of the nation because there are not enough investors. Look, I'm not a political guy. But I can praise capitalism as an engine for wealth creation. As Brian Moynihan, the CEO of Bank of America, said this morning when I interviewed him, it's just a shame that so few people care and so few people are combating inflation by investing in American business, which knows nothing about MLS and everything about opportunity for all, including those who think they can't afford it, so they don't even bother to try. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.